what should I say? Revocable. Okay, I'll try to say it. Revocable. I'm going to stick with mine. Revocable. Stuff goes in. It can come out. But on irrevocable, once you put it in, it can't be revoked. It's in there. You've completed a transfer. So, on and this is worth knowing because actually this matters for some of what we're doing here. This irrevocable trust comes in grantor and non-grantor. So the fact that it's under the grantor side just means it's a subset of what's possible for an irrevocable trust. Irrevocable, whatever. Now you got me fucked up. Okay, so a grantor trust, whether it is revocable or irrevocable, it's an appropriate shareholder. That's the point. And on top of it, part of the problem is the revocable trust or the irrevocable trust can either be grantor and non-grantor. So if we can now go back over to the rule, well, the grantor trust is an appropriate shareholder. If we fall into...
Wiggle the mouse.
Okay.
Has Snyder been listening to this whole thing?
He was also.
I am quite sure Snyder's like fully locked and loaded in this. So the grantor trust is appropriate. A grantor trust can meet the
problem?
Snyder, don't make me call on you.
You can call on me all you want. I'm not going to answer.
That might as well have been the end with, you can call on me anytime you want, bitch.
All right, I'm muting.
You guys, I swear this is like a sit-in. So you can have an irrevocable trust qualify because it's grantor. But if it busts and goes from grantor to non-grantor, you might bust your S election. So when you put something into a trust that's, what is it, irrevocable?
Irrevocable.
Irrevocable, whatever. Irrevocable, I'll do better, I'll try.
Think of like you revoke it. So start with like that, you revoke.
Well, now this is an English lesson.
So Pete, I actually like to use your pronunciation of Ben.
Because it drives him nuts?
Yeah.
Let's get him on the line.
So I texted him actually a half hour ago before this even started. And I said, are you aware Pete says revocable? And he said, well, he's from Kentucky.
Before you said it, or have you used this joke?
No, that was.
Did you use this joke?
Yeah.
So you used this joke
Yeah.
earlier, okay. Kentucky speaking. Okay, so you need to be careful. And then on the non-grantor side, which we're going to get into this, bust S selection, or SBIT, or QSST. So the fact that the trust goes from being grantor to non-grantor isn't an automatic death sentence or revocation of the S election or termination of the S election, because the trust itself can qualify as irrevocable. Now you guys, I swear to God, you got me fucked up. it is in fact irrevocable, but if it meets these other definitions of ESBIT, which is electing small business trust, or qualified subchapter S trust, it can still be a qualifying shareholder for corps. And we're going to talk about both an electing small business trust, or ESBIT. We're going to be talking about a qualified subchapter S trust as well. So the next category of that was in that, we've only covered two things, right, as part of the small business corporation definition. One was it has to be 100 or less shareholders, and now it has to be a natural person. Your rule is it has to be a U.S. natural citizen, otherwise you ask a question, correct? That's your rule. Now, in terms of trust, that's what we're talking about in this category, because a trust is possibly okay. And as long as it's grantor trust, which is effectively, how did I describe it, Sam?
What? Sorry, I was
A DRE.
thinking, but looking at you, and I
A
was.
disregarded entity. A grantor trust effectively is a disregarded entity, which means the tax consequence of whatever happens in that trust is happening on the person's 1040. That's what makes it okay for it to be an acceptable shareholder. So now, if I own the S Corp and I pass away, my shares are going to go into an estate. An estate is its own tax-paying being, and they say an estate is an acceptable shareholder even though it's not a natural U.S. citizen. But that estate can only be a shareholder for a period of 2 years, and if you get beyond 2 years, you terminate or bust your S election. So that's important. And there's an electing small business trust, which we're going to talk about. An electing small business trust is an irrevocable trust that has its own characteristics on how it's taxed. And then somewhere in here, there's the qualified subchapter S trust, which has its own characteristics. So those irrevocable trusts, was that close?
That's spot on.
Okay. Those irrevocable trusts qualify even though they've transported themselves or recharacterized themselves from grantor status to non-grantor status. So those non-grantor trusts of ESBIT, electing small business trust, or qualified subchapter S trust are both appropriate shareholders. And an electing small business trust and a qualified subchapter S trust can be created in one of two ways in general. One is I want to put shares of the S Corp into trust on behalf of my children, and I need it to be an appropriate trust, and I don't want to be the grantor. I do not want this to be treated like a DRE to me. I don't want to pay the tax. So if the S Corp shares sell or there's a big gain at the S Corp level, I don't want the income tax consequence of that. Therefore, I don't want disregarded entity status or tax treatment. Therefore, I'm going to make it an irrevocable trust, not grantor. So I'm going to kick it into, or not, I don't want it to be grantor, so I'm going to make it non-grantor. Therefore, since it's non-grantor, I got to fall into one of these two categories. And that decision is prompted by the fact I want to give a gift to my children. You can use an ESBIT or a QSST as a vehicle to hold those shares and not have the income tax consequence of the S Corp be inflicted on me because I don't want DRE status. Or, in the alternative, I die. And those shares, my children are wildly irresponsible. I don't want them to be able to affect the operations of the corporation or have access to the funds in a manner that I deem inappropriate. So I'm going to have those shares through my estate come out of the decedent's estate, which I have 2 years to manage, and get it into either an electing small business trust or a QSST, one of the two. So shares can get into an ESBIT or a QSST by gift or by death, either one. Okay, so we...
Have you ever had a situation where somebody does an irrevocable non-grantor trust kind of unethically where they're like, oh, I don't want to have the tax consequences, but they push it on their kids who might not want it either, or they're unaware of it. Like they're kind of just trying to avoid taxes essentially.
Were you from farmland? That sounds like a farm, central Nebraska farm thing.
I am from K-States.
I mean, that sounds, I mean, the farmers in central Nebraska are like the mafia. I mean, the stuff that they try to pull to avoid tax.
I think that's just all farmers.
Is it? I mean, I remember, because that sounds exactly like what a farm mind would do in central Nebraska. No, that's not uncommon, because you have to confront saying, well, that's not right, we can't do that. I mean, as a professional, but have I seen people try to play games and a shell game and say, well, it just doesn't exist? Yeah.
But then how as a professional do you make sure that that doesn't happen?
There's power in the word no, and you can find somebody else. I mean, I've fired more than one client in my life by just saying, no, we're not doing that. Yeah.
Do the kids have to sign anything when you create an irrevocable trust?
Mm-mm.
So they would have no idea if it was a thing.
Depending on the type of trust that you have, yes. 100%. And people of high net worth put things in trust on behalf of their children and don't tell them. And there's benefits and burdens to that choice of not telling them. The benefit is you hope that they believe that they have to struggle in the world to make their own way, and that there's not this slush fund of money that they can just rely on. The problem is when it hits, they're not prepared for what's coming their way. Oh, I got $20 million? I'm a drunken sailor, and I'm going to end up in the gutter face down. I mean, there's benefits and burdens to both strategies of telling your kids and not telling your kids about what's going on. And that, when it comes to estate planning and making those choices, your starting point for estate planning, now this is going down a rabbit hole that was unintended, but your starting point for estate planning is not, here's all these 10 great tools that are going to save you money. That's not your starting point. The starting point is, what do you want to have happen? You have $50 million of assets, and of those $50 million, do you want to give it to charity? Do you want to give it to your kids? Do you want to give it to them now? Do you want to give it to them later? Tell me what you want to have happen. Then we diagnose what the options are based on what the client prescribes as what their goals are to figure that out. And if they don't want their kids to know, well, all right, here's the way to do it. So you see it both ways. Okay. So you can't have a non-resident alien as a shareholder. That's me talking about. That's point number 3. So we have 100 shareholders or less. It has to be a U.S. person. I basically combined B and C because we talked about the trust, which is embedded in B, and I also said that it has to be a U.S. person, and that captures the concept in C, because you can't have a non-resident alien as a shareholder. And then the third is you can't have more than one class of stock. And so let's talk about what that means to have not more than one class of stock. And I don't know how much I talk about this. Oops. 2. You guys ain't gonna get away with that. Okay. One class of stock. What does that mean?
Can't have non-voting and
Incorrect.
Can't have preferred in common.
What do you mean no A versus B?
Like where they're different prices.
Different prices.
Like with Berkshire.
Okay, so let me say what I think you just said. Okay, and I think you're correct. I don't know if that's true or not, but because you're talking about A versus B.
Yeah.
Well, and that's a bad example for what I'm shooting for on some level, because I think if you take the A share divided by 1,500, you get to the B share price. Is it 1,500 shares? Is that what the number is?
But it's something like that.
Okay. So what second class stock, or the absence of second class of stock, what that really means is every share has exact economic rights. That's what that means. So when Lane said voting versus non-voting, voting versus non-voting does not have anything to do with economic rights. So you can have a different class of stock, and it happens frequently, especially when we were talking about gifting and transfers. Voting versus non-voting shares is something that is a consistent element that occurs in gifting. Because if I want to give away 90% of my company to the next generation, but I don't want them to control anything, I'm going to have 1,000 voting shares and 9,000 non-voting shares. And that does two things. One is I'm transferring shares that are non-voting, so you have a problem with what I'm doing, I got the vote. You can't mess with me. Okay, that was super weird. No, I was playing Spotify in my car on the way down, and it just all of a sudden decided it's time to play. Like classic rock or something, road trip rock or something. What kind of station do you think it is?
Just sound a little bit.
Prince is not exactly 100% my jam. But, so, I don't want you to have vote at all. But the second thing is, voting shares from a valuation perspective are less valuable because I can't control what's going on. So when somebody does a valuation, if every share for valuation purposes, for gifting purposes, every voting share is worth $10 per share. If I break that up into 1,000 voting shares that have control and 9,000 voting shares that don't have control, you're able to discount the $10 down to $7 for gifting purposes. So there's two things that are really occurring with respect to voting and non-voting from the estate and gift perspective. One is, I don't want any clown to tell me what to do, and my children are all clowns, I acknowledge that. The second is, I want to be able to take a discount on the valuation because I got a $12 million lifetime exemption that I have to transfer tax-free to the next generation, and I want to minimize the utilization of that by making non-voting shares and having those shares be reduced from a valuation perspective for gifting purposes. So every share has the exact economic right means that if there's 10 shares and there's $100 of income, every share has $10 of income reported on that K1. It means if there's $100 of distribution, every share gets $10. It has to have the exact same economic rights. And the minute you don't have the exact same economic rights, well, now you have a second class of stock. I confront this a lot. From your perspective, unless you're going to trend into some of the things that I do, the probability that you really need to worry about this is relatively low, because you're probably going to be reviewing a return, and all the K1s are going to proportionally spit out the income. They're going to proportionally make the distributions.
I think that's the biggest one. If you see distributions not in one to ownership, that would potentially run you afoul of this rule, and You'd want to note that.
And that's the opportunity to ask the question of what's going on, and clearly, do we bust our S election, or are we trending that way? And if I don't know if I covered this or not. It'll be interesting to see. Is that that if John takes the distribution and we're 50-50, and we miss the distribution to me, and we miss that distribution in good faith, then I can get a make-up distribution, and that's going to be okay. And the way this also works, which I think is interesting and a little bit mind-bending, John is a sole shareholder of a corporation, S corporation, and then he sells to Pete 50% of the company on 6/30. So it's Pete and John. Oops. That are shareholders. John's sole shareholder from 1/1 to 6/30, and Pete's a shareholder from 6/30 till the end of the year. And the corporation earns $1 million. And I'm sure we're going to talk about this at some point. Or let's say $1.2 million, because that math is going to be easier for me. So how is income allocated for an S corp? Sam, do you know?
Based on your ownership in the year.
Based on, so let's be more precise when you say that. Is there a different way to formulate that sentence? That does anybody know what I'm shooting for?
I mean,
Per share, per day basis.
Per share per day basis. Okay. So it's a weighted average that occurs that you're allocating that income. And if we have $1.2 million of income, and we don't have any other election like a 1377 election or a change in ownership under 1.1368-2G or whatever that is, which that's somewhere in here, to have a cutoff of your tax year, then the dollars are going to be allocated on a K1 on a per share per day basis. So at $1.2 million, 600,000 is for the first half of the year. It's all going to go to John. And for the second half of the year, 300 is going to go to John, and 300 is going to go to Pete. So the K1 at the end of the year for John is going to say 900, and the K1 to Pete is going to be 300 for a total of $1.2 million. And that disparity, and we are, at the end of the year, we're 50-50 because I bought 50% of the shares. Well, John wasn't the world's best bookkeeper, and he didn't keep up with the stuff he should have did. So at the end of the year, we have $1.2 million of income times 40% would be 480 grand, correct? Right, Lane? She agrees, therefore it has to be right. So there's 480 grand that now needs to come out as tax distribution. John and I are 50-50. Our rule is economic rights can't be different. They have to be exactly the same. We started at that rule. So using that rule, you would have to say, well, 240 has to go to John and 240 has to go to Pete. John just got shorted on his taxes and Pete got a windfall. So, TK, are we here to be experts? We're here to learn something, right? And this is worth knowing. Actually, this probably is something that you should know because this is something that you possibly can confront. So I'm going to put it in, you should know this versus middle of the road or expert. So when you have this, because we have entrance of S Corp shareholders all the time. People miss tax distributions all the time. So you have the opportunity to say, well, wait a minute, we should have gave John 240 at the beginning of the year because that would have been the tax distribution associated with that. And we should have given 120 each at the end of the year. So even though we deferred the tax distribution out of the entity until the end of the year, we have the opportunity to say that's not the way the income was allocated. Our tax distributions need to be congruent with the income allocated to them. So even though we were 50-50 at the end of the year, we are allowed to make this disproportionate distribution out of the entity and not be in violation of having the exact economic rights. And there's some other things. This probably falls more into expert, but there's things in buy-sells that you can do that seem to appear to violate the exact economic right. That would be in expert material and knowing what those rules are. Because there's stuff in buy-sells that can cause you some heartburn, and you need to know what those are and be cognizant of them if you want to consult on an escort buy-sell. So the other thing that occurs is, well, you know what? Pete's kind of a slouch. John's a good, honest guy. And we're both 50-50 in the escort. And I'm like, look, John, I don't want to pay taxes. I just want to run shit through the corporation. And John says, look, I don't want to do that. I want to be honest. But if you want to do it, and we're going to have a side agreement, we'll true it up. I renovate my whole house and run it through the company. John says, well, I'm going to equalize that by taking a salary because I'm an honest guy. Well, that says that amount that went out to renovate my house was a disproportionate economic benefit that I took out of the company, which sure looks like a distribution, which sure looks like I took a distribution John didn't, which sure looks like I have an economic right that John didn't, and then I busted my S-election. So if you have somebody that's dipping their beak into the company till in an appropriate way, not that we do that, you could possibly have a second class of stock. Second class of stock issue. The place that I see this, and I confront this on a regular and continuous basis. Damn it! I keep erasing that. 10 and 2, right? That's what we agreed to. Is when a company sells all its assets in exchange for a note or notes. And those notes come in different categories. One is a note that is going to be paid relatively quickly. One could be a contingent earnout. One could be an escrow for reps and warranties. These notes are going to come in with different characteristics. So in a transaction, I've seen this a lot, where these various notes are coming in exchange for the assets. Well, what people want to do is say, you know what, we want B to be out of this completely. We don't want them to have any risk associated with a contingent note. We don't want them to have to worry about reps and warranties. We don't want them to worry about any of that. So what they want to do is give the short-term note disproportionately to B, because we want them just to get their cash and go away because we don't want to cause them a problem. But the contingent note and the escrows plus the balance of the short-term note go to A. And the question is a contingent note that I might get paid on of equivalent value as the note that I'm going to get paid on for sure. So let's do an experiment. Jameson, if we're going to liquidate the corporation and there's a contingent note that's worth $1,000 and we might get paid on it, and there's a note, and we're 50-50, and there's a note that says there's $1,000 coming for sure, and I say, hey, there's a $1,000 note contingent and a $1,000 note for sure, Jameson, you take the $1,000 note contingent. I'll take the one we get paid on for sure. How do you feel about that?
Not good.
Not good. Why?
May not get my money.
You may not get your money. So the economic rights with respect to those notes are wildly different. Since the economic rights of those notes are wildly different, we are no longer in the every share has the exact economic right. Therefore, we liquidated out those notes. Jameson, you're going to get 50% of the foreshore note and 50% of the contingent note. I'm going to get 50% of the foreshore note and 50% of the contingent. And then, you know what? You were a good person that helped me out, and we don't even want to talk about what that transaction really is because that's not why we're here. There's nothing nefarious, but we're just not going to go down that rabbit hole. I'm going to take your contingent note. I'm going to give you your cash for your portion of that contingent note to make you whole because you never signed up for that risk. But we got to take those notes out ratably to make sure that we don't violate the second class of stock rule. The second class of stock rule, or having a single class of stock, however you want to view it, I say second class of stock is in violation versus it's required to have one class. The second class of stock rule, I am super sensitive to when I'm doing transactions.
My experience is that attorneys that I've dealt with want to shortcut that, and they'll say, well, we know Pete's supposed to have this note, whoever's supposed to have this note, let's just have them go straight out the way we want it. And you kind of got to push back and say, no, you need to do everything pro rata and settle it up outside the court, otherwise risk. Two classes of stock, and I think that's a pain in the ass, but just got to push back and tell them. So,
Well, I had an attorney pushing back pretty hard on this, and they were being pretty obstinate. They were basically saying, you can go screw yourself, we're not going to do it that way.
who was it?
Not going to say, especially on tape. It's the minion to the guy I don't like. You know what I'm talking about?
I can narrow it down to 2 or 3.
You got it. And I basically said, I mean, there's a lot of power in the word no. No, that's not going to happen. And if you think you're going to make it happen, all right, well, let's play. So this attorney was saying, I'm not going to do that. You're being stupid. Fine. I'm being stupid. But I'm going to pick up the phone, and I'm going to call the client, and I'm going to say, albeit the risk is minimal, that somebody's going to smoke it out, and then there is actually a defense that you can mount to try to avoid the second class of stock. So their pushback of saying, why are we doing this, isn't lost on me. But if it goes poorly and the IRS successfully asserts that I have second class of stock, I've now subjected my asset sale to 2 levels of tax, which is catastrophic. So I say, fine. I'm going to call the client. And I'm going to say, you're making this choice. I'm not making it. And I'm going to say, the risk, albeit small, is catastrophic. And if the risk comes to fruition, the attorney is going to be happy to settle this up with you. That's what I'm going to say. So if you want me to say that, that's what I'm going to do. And they go, we'll draft it your way. But if the horse has left the barn, you're stuck with trying to defend against the fact that it wasn't drafted correctly, where Jameson got 100% one note and I got the other. Am I going to say that we busted our S election? No. But I am going to say we got risk. And that risk, albeit not the world's biggest, because it might most likely it's not going to get audited, and even if it does get audited, we can argue from this particular point of view, and we got a shot at least at holding our ground. But you don't want to go down that road if you don't have to. So you can't have more than one class of stock. Ineligible share or corporation, financial institution, insurance company, DISC, or former DISC, I really don't care because we don't really deal with those. Treatment of wholly owned subsidiaries. Jimmy, what are you talking about?
What? Q subs.
Q-sub.
Don't knock it till you try it.
I don't even know what to think about that. Okay, I'm gonna leave that alone. That's just gonna.
Can I ask a question before we move on?
Sure.
Okay, so with like the attorney situation where they want it to be a certain way, but we need it to be another, like the way it needs to be for tax. So we would make sure that it's done appropriately within the corp for tax purposes. But then would we just like tell the clients that once it's through the corp, they can do what they need to do on their end?
You're saying if we screwed it up?
No, if we do it right, but it's not how they wanted it to be done.
The client?
Yeah,
The client's not gonna give a shit.
it's just the attorneys that give a shit. Okay.
Because at the end of the day, what I say is, well, I'm going to change it from 50-50. I'm going to say Jameson is 10%, and I'm 90%. That's more likely how this is going to go. So we got $2,000 notes. Jameson is owed $10 of the short-term note and $10 of the contingent note, and I get 900. What the attorney wants to do is say, I don't want to deal with that. We're going to give her $20 of the short-term note just to
200?
make her whole. Do what?
200?
Or yeah, 200. So we're going to give her 200 of the short-term note. And you are going to get 800 of the short-term note and all 1,000 of the contingent. No, what's going to happen is she's going to get 100 of contingent and 100 of short-term. Then we're going to have a contract between Jameson and I that says, I'm going to give you $100 for the contingent note. And we're going to have a transaction outside the corporation that gets us where we want her to be.
Okay. So you still do, like you can do an outside.
100, yes.
Okay.
It's all above board, it's just an extra document that they don't want to draft.
Oh, that's the only reason they care?
Yes.
Oh, that's so dumb.
Yes.
So dumb.
Okay, Q subs, which we're going to talk about, which this piece, if you have this page where I have it highlighted, this is where this morning when we were talking and I lost everybody in the room so bad was 332, 337, and 334, which was the tax deferred liquidation of a corporation. Those rules are going to be applied in this section 3. Because you have, again, an S corp that owns another corp. X owns Y. So let's go back through our rules. In order to be an S corporation, you have to meet what definition, Lane? Small business corporation. So it has to be a natural U.S. citizen as owner, one class of stock and less than 100. So is X a natural U.S. citizen?
I think so.
Natural means a human being.
No,
No.
that is not.
Okay, so we've now screwed up the definition of who can be a small business corporation, because X does not meet the definition of a natural U.S. citizen, a natural U.S. person, which is an individual. So what this says, hey, if Y it's not an ineligible corporation, which is a former disc or a financial institution, and it meets all of the requirements, and you make something called what, Jimmy?
Q sub.
Q sub election. Y can be owned by X, but you have to have this Q sub election. And the Q sub election basically runs the rules of 332, 337, and 334. Because a Q sub, like a grantor trust, like a single member LLC, is a disregarded entity. It's DRE. So all the assets and liabilities, even though the land is in Y, legally, it's really deemed to be in X. So that's Q7. We'll be talking about that. Oh. We haven't done yet?
I am.
You said that.
Me.
No.
Jeff.
Actually, I believe you.
I mean, I wasn't lying.
Let's see. Okay, so this is 2553. We talked a little bit or a fair amount about 2553, but there's a couple things that are worth noting about the 2553 is there's this late relief section, and I declare I had reasonable cause. Those are the words that you highlight. I declare I had reasonable cause. And the I declare I had reasonable cause is because I have an idiot accountant or I have an idiot attorney who should have filed the 2553 and they neglected their duty. And there may or may not be truth in the sentence that they were relying on them to do that. But that is very common, is to the words that we had reasonable cause. The second thing that's worth noting is this signature line. The signature on the 2553, I think, I'm almost positive, can be signed by an officer of the corporation. It doesn't have to be a shareholder, I think.
What it says.
Yeah.
Does it? Okay. All right, well, I got that right. Okay, but this section, part 1, has to be signed by every shareholder. So, if we have, and I have encountered this,
Who is expected to fill it out most of the time? The attorney or the accountant?
it's mixed.
Okay.
It's mixed. And personally, if I can punt it off to the attorneys, I do, even though that's money that we make. I don't care, and it takes one slight risk off my plate, but we can do it, and we can do it appropriately, and we do it well. I just don't like compliance anymore, and I'm not good at it. We should do it. Let's go with that.
Are you
But-
ever, I don't want to use the word scared, nervous when you punt it off to the attorneys of them if they make a mistake doing it?
Sometimes.
Not even just with this, but like even when attorneys do gift tax returns. Like sometimes I'm like, oh, did they do that right?
You know what? The fact, gift tax return, if they want to do it, have it. If they want to do an estate tax return, please do. And if you do it wrong, great. That's your problem. And I want to be my client's advocate. But if I'm not good at it and they want to assume the risk, guess what? I'm good with it. And actually, John and I share an example, and we talked about it within the past couple days, where I'm not comfortable with this particular subset of law. And this particular subset of law, I think, is toxic. John, on the other hand, feels rather comfortable that he knows it. Substantial modification of a note. And very early on in this process, 10 years ago? Probably 5, 6. It's been a long time. And we're still dealing with it. I put the attorneys on the hook for this thing. I said, I don't know how this works. Well, we'll take it. Great. Take it. I don't want it. And if that toxic waste dump turns into a toxic waste dump, it's your toxic waste dump, not mine. So there's only two answers. Sam, what are they? The correct answer, and I don't know. And I don't need to be a hero or have the client think I know everything. I don't need to be that. I know the stuff I know, and I'm intellectually honest with myself to say I don't know that. And if they know it and I don't, my discomfort that they're taking it, if they're screwing it up, I don't know, because I don't know. That's on them. And there's a lot of power in the answer no. No, that's not going to happen. And there's a lot of power in, I really don't know how that works. And my vanity is allowing me to say, I don't know. Because I know some other stuff. I'm valuable in other ways. Here's the stuff I do know. So the fact that somebody else is taking the gift tax return or something else and they're better at it than me, all right, you're better. Yeah, you. Because the client wins, I win, everybody wins in that scenario. None of that bothers me. Okay, so Pete and John on January 1st are S Corp share are shareholders in the corporation. Pete wants to retire. John buys his shares, and John is now the sole shareholder from 2/15 on. Pete has been a barrier to making an S election because he didn't want the noise. He just was happy having it be taxed as a C because he didn't want any of that income to flow to his return. He didn't want to deal with it. He didn't want this per share per day. He didn't want to make estimated tax payments. He didn't want any of it. So he and John have been at an impasse. So John now is the sole shareholder of the corporation. John wants to make an S election. Pete's gone. Can John make the S election for this year?
We're at 2:15.
Do what?
What date are we at?
2/15 is when he bought me out. 3/15 is the date that the S elections due. The answer is he can't. Anybody that's going to be affected by the S election, so even though I'm no longer part of the corporation, has to give their consent if they're going to get a K1. So if John wanted to elect S status, the S status, even though if it's filed on 3/15, reverts back to January 1st of that particular year. It reverts back to January 1st of that particular year. I was a shareholder of the corporation of that particular year. And if I was a shareholder of that particular year, I'm going to get a K1. I have to consent in this section. So an exiting shareholder or a new shareholder that would have been required to make it in that window between 1/1 and 3/15 has to sign. And they have to say, yep, I'm good with being an S Corp. So you have name, signature, date, percent owned, dates acquired, social security number, whatever. I don't care. You guys can read better than me. Oh, I don't want to talk about 444 election.
Why?
Well, did you say wipe?
Yeah.
You are actually having fun. Okay, so an S Corp
One of us.
really like. I like Sam's attitude better. An S corporation, thank you, John. An S corporation is required to be, well, yeah, it's required to have a required year end. And a required year end means that it has to be 12/31. It automatically reverts to 12/31. The S Corp's required year end is 12/31. So some companies say, I don't want to be on 12/31. I want something other than 12/31. So this 444 election says we'll allow you to file a form, I can't remember the form number, that's a 444 election to say I want to be either a 9/30 year end or an 11/30, right? November's 11/30, sorry, or December or September 30. I want to be 9/30, November 30, October, November. One of those three. I was all fucked up.
That's
And I'm surprised why you catch me.
Okay, so what is it?
Either I want to be a September, October, or November year end.
So the last quarter.
Yes. And the 444 election allows you to be on those year ends if you want to. And if this comes up, seriously, write in your notes, if you need to do a 444 election, call Ty Bardsley. He beat the ever-loving shit out of this. And the number of times I was wrong because I thought I knew something was something more than once on this. So Ty's beat this up pretty well, but a 444 election allows you to have a tax year end at the end of the year, or the last quarter of the year,
Why wouldn't you want to have, like, why would you want any other tax year?
other than 1231.
Yeah.
The one he was looking at did basketball camps. So basketball camps just run through a specific period of time with a natural slowdown period at 9:30, evidently. So they don't want to mess with. They want to mess with the year-end cleanup when everything slows down. So they wanted a 9:30 year-end, so they didn't have to mess with cleaning things up while the kids are back in school and signing up and having with tax returns. But I need to do these basketball camps. I want a 9:30 because it's way less noisy.
Gotcha. So it was actually like a legit reason.
Yeah. And okay, so there's one other thing that I need to say about this now that we brought it up. If you want a 9:30 year end, let's go back over here and say that okay. Okay, so you have a corporation that earns $100,000 per month. So, Lucas, how much does it earn on an annual basis?
1.2 million.
1.2 million. We're cutting coupons. We earn $100,000 a month. So if the corporation makes a 444 election to be taxed at 930, that means that we have a tax return that's due with a tax year on 930. How much did the company earn through 930, Lucas?
100,000.
900,000. Okay? But you have an individual that has a year end of 1231. And this is their only activity, is this K1. What's going to be on their 1040 in terms of income?
The whole year, right?
No.
Or no, just the first 9. Okay.
900.
Is this only the year of election? Because wouldn't you have the previous 1231 to 11?
This is the, yeah, yes, that's right.
Okay.
But that's assuming we have linear earnings. So now the individual has 900,000. So this seems like a really good idea to elect to have a different tax year, so I can defer the 300,000 that's being earned in the last quarter. Well, do you think the IRS is smart enough to figure that one out, Lucas?
Probably, yeah.
They are. So by May 15th, a taxpayer has to file a Form 8752, which says that there was $300,000 of deferral, and that $300,000 of deferral has to be reported on 8752. And when you report that on the 8752, the highest individual tax rate is 37%. But for ease of math for me, I'm going to put it at 40%. Unless, Lane, do you want to do my math? No. Okay, good. Okay, 40%, 120,000. So the IRS says, okay, we understand that you only had to report 900,000 on your tax return because the K1 is produced on a short year. So to the extent that you have a deferral in that last period, you have to take those deferred dollars and report it on 8752, and you owe us a $120,000 deposit the next year, May 15th. The corp does. The corp does. So what happens is, let's now say, let's look at it two different ways. Let's say that Lucas is doing a great job running this. Instead of earning $100,000 a month, it's $200,000 a month. So my deferral went from being $300,000 to $600,000 in year 2. So $600,000 times 40% is $240,000. So in year 2, I have $240,000 that's required. I have $120,000 on deposit. So I owe $120,000 because I already got $120,000 on deposit. Lucas has lost focus. And going from $200,000 a month, he goes to zero because he's lost focus. Which means now my deferral at the end of the year, year 3, is 0. 0 times 40% is 0. I got $240,000 on deposit. 0 is required. I get a $240,000 refund. So that deferral period, you got to quantify the income that occurs in that deferral period. Take it times the highest incremental individual tax rate, compare it to what's on deposit, and either you owe something or you get something back. So they aren't, while you get this natural business year end on this basketball camp, they don't get the deferral. They still have an obligation to pay into the system the dollars. Is that a good rule or a bad rule? Because to your point, Jameson, you're saying that deferral really is only a one-year thing. Maybe, maybe not, because of variation of income.
Like an escrow account and a mortgage.
Yes. 100%.